In this video, I'm going to first explain what estimated credit loss is, then how to calculate it. Okay, so before IFRS 9, losses from bad debts were only recognized when the bank incurred the loss, typically when the borrower defaults. But IFRS 9 said, that's crazy. We should be more proactive. So instead, IFRS 9 requires us to recognize credit losses as an expense as soon as we know that some of our customers are going to pay us back. It's a forward-looking model. So instead of waiting for borrowers to default, we can anticipate how many of our customers won't pay us back. And that might sound easy, but in reality, it's anything but, since it requires loads of data, judgment, and calculations. But once you understand it, it's not that complicated. So let's start with the core principles first. Okay, so the first principle is that it's expected, not incurred. That means we're going to use probabilities to estimate the amount of credit losses. And we do that by considering three things: past events, current conditions, and forward-looking information. Forward-looking information includes things like macroeconomic forecasts and industry trends. Second, we need to identify the likelihood of a customer defaulting. And we do that using the probability of default, or PD. The second thing we need to identify is the loss given default, or LGD, which is the amount of money we're likely to lose if the customer defaults. And finally, the third thing we need to consider is exposure at default, which is how much money is outstanding, and that brings us to the formula for expected credit loss, which is simply PD times LGD times EAD. Now, once we have all these inputs, we can estimate the amount of credit losses we expect to incur. And the cool thing is that they're forward-looking, meaning they consider future expectations about a company's ability to repay its debt. And just for the record, who needs to use the expected credit loss model? Well, banks and other lenders obviously, but also corporates that have significant amounts of trade receivables or lease receivables. Okay, so now that we understand the core principles of ECL, let's see how they apply in practice. And just so you know, IFRS 9 gives us a choice of two models. We can either use the simplified approach or the three-stage model. The simplified approach is only available to entities with trade receivables and lease receivables. And for those types of receivables, we can ignore the first stage altogether and jump straight to calculating lifetime expected credit losses. On the other hand, if we don't qualify for the simplified approach, we have to use the three-stage model. And this model considers whether the asset is performing, significantly increased in credit risk, or credit impaired. So if the asset is performing, we estimate the expected loss over the next 12 months. If the asset has a significant increase in credit risk, we estimate the expected loss over the life of the asset. And if the asset is credit impaired, we estimate the expected loss over the life of the asset, and we also remove any interest on the amount of the loss allowance. But what are the triggers for moving between these stages? Well, in general, it's based on changes in credit quality, such as the borrower becoming 30 days past due, or being downgraded by a credit rating agency. And here's a simple illustration of the three-stage model. Okay, so here we have a simple example of a loan for $100,000. In the first stage, the loan is performing, so we estimate the expected loss over the next 12 months. That comes out to 2% of the loan amount, or $2,000. So we book a provision for the full amount of the expected loss. In stage 2, however, the credit risk on the loan has increased significantly, so we estimate the expected loss over the life of the loan. This time, it comes out to 10% of the loan amount, or $10,000. So we book the additional provision of $8,000, $10,000, $2,000. And finally, in stage 3, the loan becomes credit impaired, so we continue to estimate the expected loss over the life of the loan. But we also stop recognizing interest on the amount of the loss allowance. Okay, so now that we know the 3-stage model, let's work through a simple example together. Okay, so we have a basic loan for $100,000. Let's say the bank knows that the lifetime probability of default is 2%. That means if we lend $100,000, there's a 2% chance that the customer won't pay us back. The LGD is 50%, which means if the customer does default, we expect to recover 50% of the loan. And finally, we assume that the exposure at default is the full loan amount, which is $100,000. Now, to calculate the ECL, we simply multiply these 3 factors together. 0.02 times 50% times $100,000 equals $1,000. So the bank would book a provision for $1,000. But let's say that after making the loan, the bank's credit risk team identifies that the customer has started missing payments. After assessing the situation, they decide that the lifetime PD is now 10%, which means there's a 10% chance that the customer won't pay us back. The bank updates the ECL calculation using the new PD, and since it's now 10%, that means the new ECL is 10% times 50% times $100,000, which equals $5,000. So the bank would book an additional $4,000 in provisions. Okay, so now let's look at another example. This one involves trade receivables. And if you didn't know, IFRS 9 allows us to use a provision matrix to estimate expected credit losses on trade receivables and lease receivables. A provision matrix is basically a table that shows us the expected credit losses based on the age of the receivables. So, let's take a look at this example. Here we have trade receivables of $80,000. We want to calculate the ECL using the provision matrix. So the first step is to group the receivables into different aging buckets. So we have the current bucket, 1 to 30 days past due, 31 to 60 days, 61 to 90 days, and greater than 90 days. Then we need to find the percentage of the total receivables that fall into each bucket. So, for example, 50% of our receivables are current, 20% are 1 to 30 days past due, and so on. Next, we need to find the expected credit loss rate for each bucket, and we can do that using the provision matrix. For example, for receivables that are current, we would look at the first row of the matrix and see that the expected credit loss rate is 1%. Now we can calculate the expected credit loss for each bucket by multiplying the bucket amount by the expected credit loss rate. So for example, the ECL for current receivables is 50,000 times 1%, which equals 500. Finally, we add up the ECL for each bucket to get the total ECL. So 500, 600 plus 1,000 plus 1,250 equals 4,350. So the total ECL for the company's trade receivables is 4,350. And that's pretty much it when it comes to calculating expected credit losses. Of course, in practice, there are quite a few challenges and areas where judgment is required. For example, we need to have data on PDL, GD, and forward-looking information, We also need to decide what constitutes a significant increase in credit risk. There's also the issue of macroeconomic overlays and scenario weighting, not to mention model governance and audit scrutiny. But I'll leave all those issues for another video. For now, I hope this gave you a good overview of IFRS 9 and how to calculate expected credit losses. Alright, thanks for watching and see you in the next video.